We now begin with our discussion on Unit 2 of Financial Reporting and Analysis. The reasoning of putting this unit at the end of the other discussions is basically that we get a sense of what is the balance sheet, what is the P&L, what is the cash flow, and understand the need of the three statements. And only then we really go about trying about specifically what is the accounting entries to that, what is the process of recording those entries. In the context of management education per se, it's good to know these accounting jargon and the fact that how the accounting process works, but in reality it is more the understanding of the three statements that is more relevant for us rather than the preparing of the statements, right? This portion is going to talk a little bit about preparation of those statements, about how we link those entries or transactions that happen in a business and try and create some sort of an account using those transactions. And that is what is going to form the gist of this entire discussion. What we have done so far is, without using any of the accounting discussions, we have basically covered some of the important aspects of how do we go about creating a balance sheet, a P&L, and a cash flow statement, and trying and linking the three statements. What is the impact that one transaction has on the other transactions, right? Other statements. So now we are going to start with what accountants do, basically understand how the process of recording these transactions works and how those statements actually get created, right? That's the crux of this particular unit. And now that we understand the importance of each of those specific statements, it might make more sense for us to get into details about how do we record those transactions, right? So we'll try and understand accounts. We'll try and understand what do we mean by debit and credit. These are two of the most commonly used terms in this entire accounting recording process. Also tend to be a little bit confusing if you go by the textbook definitions, but we'll try and create a very simple thumb rule which kind of eases out how do we record debit and credit in the accounting statements. Accounting types and rules, what are the key steps in recording the process of recording these statements. And then we will look at the journal, ledger, and trial balances. And from trial balances, eventually we do end up creating the financial statements, right? Before we go and talk about all that, let's talk about what do we mean by an account. Now, an account is an individual recording, accounting record of increases or decreases in either a specific asset or a liability or owner's equity item. Remember, in the balance sheet, for example, you will only have three items. You will either have a owner's equity or liability, and that will be equal to your assets, right? So an increase or decrease, that's an individual accounting record. That's what is called as an account. So for example, the company would have separate accounts for cash, accounts receivable, accounts payable, service revenue, salaries and wages expense, and so on. When we say accounts, it doesn't mean there is a bank account as such. It just means that we have created a header. It's a heading, it's a title where we will record all these transactions, and that's what is called as the account, right? Note that whenever we are referring to a specific account, we capitalize the name. So we kind of put the name as capitals there. In its simplest form, any account consists of three parts. So basically there will be a title, there will be a left or the debit side, and there will be a right or the credit side. So typically the way it is made is there is a title here, there is a left or the debit side, and there is a credit side. And because of the shape in which it appears, it is also known as a T account because it looks like a T, right? So that's what we mean by an account. That's how most accounting relationships work. So it'll appear as something like a title of the account. So maybe let's say cash account or something, and then transactions that are on the debit side and transactions that are on the credit side, left side and right side. And we'll discuss what do we mean by left and right side and what do we mean by debit and credit in a moment, right? But that's how basically we show this. That's how it appears on any kind of accounting system, right? Now, what do we mean by debits and credits, right? Let's understand that the term debit is basically the left side of an account and credit is the right side of an account. They are commonly abbreviated as DR and CR, DR for debit and CR for credit. They do not mean an increase or decrease as is commonly thought, right? We'll discuss in terms of how do we debit something and how do we credit something. We use the terms debit and credit repeatedly in the recording process to describe where entries are made in accounts. For example, if you're entering an amount on the left side, it is called debiting the account. If you're entering an account entry on the right side, making an entry on the right side, that's called crediting an account, right? So that's what we mean by the debits and credits portion of this entire accounting system, right? So that's about debit and credit. Let's try and understand how does it work. Now, when comparing the totals of the two sides, an account shows a debit balance if the total of the debit amounts exceeds the credit. An account shows a credit balance if the credit amount exceeds the debits, right? So the balance is put at the end. So just take an example. We're looking at a cash account, right? Cash account. Cash is an asset, and we'll see how increases and decreases work. So if you look at the cash, this is a plus, and then there is a minus, then there is a plus, plus, minus, minus, and plus. So whenever cash is added to the account, we are doing a debit. And whenever cash is taken out of the account, we are doing a credit, right? So 15,000 comes in, that's a debit entry. 7,000 goes out, that's a credit entry. Then we have 12,000 coming in, that's a debit entry. 1,200 coming in, sorry, that's a debit entry. 1,500 coming in, that's a debit entry. 1,700 going out, 250 going out, those are credit entries, right? 600 coming in, debit. 1,300 going out, credit. When we add all these together, you started with an opening balance of 15,000 and you ended with a closing balance of 8,050, right? That's what is called, and because debits are greater than credit, it's a debit balance here, right? If credits were greater than debits, it would have been a credit balance on the other side. Then you would have put the number here, right? So that's basically just showing inflows versus outflows in a sense. In this particular cash account, you are saying whether money has come in or whether money has gone out, and that's what is comprising this entire debit and credit on this particular account, right? So that's what we mean by debits and credits when we look at. Now, when we learn the different rules on what accounts get debited and what accounts get credited, we will create a simple rule of thumb to understand the process. Just remember one thing when you're creating this account, and that one thing is that an increase in assets will result in a debit. Anything that causes an increase in assets is going to come here on the debit side, right? Now, everything follows from this one single thumb rule, right? An increase in asset. So if assets go up, that's a debit. If assets go down, that's a credit. We just saw an example in the cash account, right? If liabilities go up, that's going to be a credit because that's the opposite of assets, right? Effectively. So any transaction that causes liabilities to go up will create a credit. We'll credit that account. And anything that causes liabilities to go down as such, we'll create a debit on that account, right? Now, we might say that when liabilities go up, assets go up as well. But remember, the debits and credits are working on different accounts, right? So if I raise a loan, and we will look at some of these examples. If I raise a loan, my loan account goes up and my cash account goes up, right? Now, where the debit and credit will get recorded, we will look at those transactions as we go along, understand those transactions as we go along, right? That's the broad construct of what we're going to do. So just remember this one single thumb rule that an increase in assets will result in a debit. We will follow everything else from this one single thumb rule. This will become clearer as we go along, but let's just try and freeze the idea of the fact that an increase in assets is a debit entry, an increase in liability is a credit entry. Consequently, decrease in asset is a credit entry, right? And increase in liability is a debit entry. Now look at what happens with the P&L transactions. When you look at sales and expenses, increase in sales, right? What is it going to do? It's basically going to increase the profit. An increase in profit, just remember it this way, because it increases the profit, it will go and increase the owner's equity. Owner's equity is a liability. Since liability is increasing because of increase in sales, that increase is counted as credit. I'm just giving you a simple thumb rule to remember these debit and credit transactions, right? So increase in sales minus costs or expenses is going to give me profit. If sales go up, profits go up. If profits go up, owner's equity goes up, which basically means liabilities goes up, which means it's a credit. Correct? Similarly, an increase in expenses will take profit down. That will reduce the owner's equity, reduce the liabilities, and hence that would be a debit entry, right? So effectively, how do we debit and credit these accounts is primarily flowing from one single thumb rule, which is just remember that an increase in assets is going to get a debit creation, that will be a debit entry there, right? Now, and the equality of debits and credits provides the basis for all the accounting transactions essentially. And we are basically saying that the entire double entry system where every transaction, recall that we had discussed in the balance sheet that every transaction is either going to make an impact on both sides of the balance sheet or will rearrange items on same side, right? Take an example. If I take a loan, so liabilities go up and consequently bank balance also goes up on the other side of assets, right? Now, if I use some of this cash and go and buy fixed assets out of it, so cash goes down, fixed asset goes up on the asset side. That's rearranging of the same side, right? Every transaction will have two entries, two impacts on the balance sheet. Either it'll affect both the sides of the balance sheet or it will rearrange items on the same side of the balance sheet, right? That's what the double entry system is called. The double entry system, the dual sided effects will get recorded in appropriate, of each transaction is getting recorded in appropriate accounts. This system provides a logical method for recording transactions. What it ensures in accounting terms is that no transaction is missed, and every transaction having the double entry or the two impacts on the balance sheet are kind of recorded here. It also ensures the accuracy of the accounts and the amounts in those accounts, right? Recorded amounts. If every transaction is recorded with equal debits and credits, the sum of all debits to the accounts must equal to the sum of all credits, right? If every transaction has equal debits and credits, then sum of debits to the accounts must equal to the credits. At the end of the day, it is going to match, because whatever is not matching is going to be either a debit balance or credit balance, and that's going to increase or decrease your accounts at the end, right? It's effectively like if I start from a particular balance sheet, I will end with another balanced balance sheet. I cannot have another way out there, right? So as we record these transactions, we will understand that slightly better, right? Now, debit and credit procedures for assets and liabilities. Debits will increase assets. We've already seen this. And credits will happen when decrease of assets happen. Increase in liabilities are credits, decrease in liabilities are going to be debits, right? Assets basically show a debit for increase, credit for decrease, and your balance comes here in case you have more there. Debit, normal balance is typically here because a profit making company will see an increase in assets over a period of time. Automatically, a profit making company will also see an increase in liabilities over a period of time. So debit for decrease, credit for increase. So the normal balance will come here. Similarly, owner's equity is a form of a liability. Owner's equity is a form of a liability. So debits will decrease the liability and credits will increase the liability, right? Similar to the liability structure is what you see here. Owner's drawings if the owner takes money out, right? That's what an owner drawing is, drawing money from the account. It's exactly the opposite of owner's equity transactions. If drawings increase, that means the owner's capital or equity will decrease. So increasing drawings is equal to decreasing owner's capital, right? If I take out more money, less money is left. If I take out less money, more money is left. So decreasing owner's drawings is a credit, increasing owner's drawing is a debit, right? And that's simple. Basically, if I take out more money, then that will decrease the owner's capital, which will mean a debit, right? So it's like if I take more dividends, it's like a dividend. If owners take out more money, those are dividends. Dividends taken out. If you increase the dividend, owner's equity will go down. So whatever happens with owner's equity going down, you see a debit, you'll do that, right? So that's basically your debit and credit procedure for the balance sheet. For revenues and expenses, increase in revenues and decrease in expenses are both credit. Remember, we saw increase in sales minus expenses is profit. So if sales go up, profits go up. Profits go up means liabilities go up, and liabilities going up are credit. Just remember it this way. It's easier to remember it this way, right? So debit for decrease in revenues and credit for increase in revenues. And typically you see revenues increasing, so the normal balance comes here. Debit for increase in expenses, credit for decrease in expenses. Typically in a growing company, you'll see a normal balance here, right? Now, this basic accounting equation was assets is equals to liabilities plus owner's equity, right? Increase in assets is debit, decrease in assets is credit. Increase in liabilities is credit, decrease in liabilities is debit. Owner's capital, exactly similar. Owner's drawing is just the opposite of owner's capital. Revenues are exactly similar to your owner's capital or liabilities. Expenses are exactly similar to your asset side, right? When you increase an expense, you're basically in a way kind of creating an asset in some vague manner, right? So effectively, your expenses and assets get treated the same way. Your revenues and liabilities get treated the same way in your debit and credit procedure, right? That's the broad understanding of how debit and credit procedure works. With that, we come to an end to this particular discussion. Now, just try and answer these couple of questions here. Explain the benefits of the double entry accounting system. What are the key benefits that it draws to us? And where and how would you classify the following, whether it would be a debit or a credit, an increase in assets, an increase in liabilities, and a decrease in revenues? Thank you.